Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and thank you so much for joining me for another episode. Today, we're going to talk about something that every single investor and trader will experience at some point in their journey, regardless of how experienced they are, how much money they manage, or what markets they invest in. That topic is managing drawdowns without panic. Now, I know this isn't always the most exciting subject compared to discussing market rallies or finding the next big investment opportunity, but I honestly believe it's one of the most important conversations we can have. The reason is simple. Nobody survives in financial markets by avoiding losses completely. Success comes from learning how to manage losses properly, stay emotionally disciplined, and continue investing with confidence over the long term. Whether you're investing in stocks, ETFs, Forex, commodities, indices, cryptocurrencies, or building a diversified retirement portfolio, periods where your investments lose value are completely normal. In fact, they're unavoidable. Even some of the greatest investors in history have experienced substantial portfolio declines. Yet they continued building wealth because they understood something many newer investors don't. They understood that temporary setbacks are simply part of the investing journey. That's why today's discussion focuses on drawdown management investing and the long-term survival strategies that can help you navigate difficult markets without making emotional decisions you'll later regret. So let's dive in. First of all, let's make sure we're all talking about the same thing. What exactly is a drawdown? A drawdown measures the decline in the value of an investment or portfolio from its highest point to its lowest point before it begins recovering. For example, imagine you've built your investment portfolio up to $130,000. Then markets become volatile and your portfolio falls to $104,000 before eventually recovering. That represents a 20% drawdown. Now, drawdowns aren't all the same. Some are relatively small and only last a few weeks. Others can extend over several months or even years depending on broader economic conditions and what's happening around the world. There are countless reasons why drawdowns happen. Economic recessions can reduce corporate earnings. Inflation can increase costs and pressure consumers. Central banks may raise interest rates. Companies sometimes disappoint investors with weaker earnings. Political uncertainty can create hesitation. Geopolitical conflicts can affect global markets. Investor sentiment can shift dramatically. Unexpected global events can occur without warning. The important thing to understand is that these events are largely outside our control. We cannot predict every market-moving event with complete accuracy. What we can control is how we prepare for them. That's really the foundation of successful drawdown management investing. Now here's something many investors don't realize. The biggest threat during a market decline often isn't the decline itself. It's panic. When markets start falling, something changes psychologically. Financial news suddenly becomes overwhelmingly negative. Every headline seems to predict disaster. Social media becomes filled with fear. People begin checking their investment accounts several times a day. Every small market movement suddenly feels significant. It's during these moments that investors often make their worst decisions. Some sell quality investments after prices have already fallen substantially. Others abandon carefully planned investment strategies they've followed for years. Some move entirely into cash because they simply can't tolerate seeing further losses. Others become overly aggressive, taking excessive risks in an attempt to recover quickly. Some constantly jump from one investment strategy to another because they're reacting to headlines instead of following a disciplined plan. Unfortunately, these emotional reactions frequently turn temporary losses into permanent ones. Fear leads to poor decisions. Poor decisions create larger losses. Larger losses increase fear. It's a cycle that feeds itself. The investors who consistently succeed over decades understand the psychological trap before it happens. They don't pretend they're immune to emotion. Instead, they prepare systems and rules that prevent emotion from taking control. Another important mindset shift is accepting that market volatility is perfectly normal. Many investors subconsciously expect markets to move steadily upward, but history tells a very different story. Bull markets have always experienced corrections. Even during long periods of economic growth, it's completely normal to see market declines of 10, 15, or even 20%. Markets simply don't move in straight lines. Experienced investors understand this. Instead of asking, "Why is my portfolio falling?" they ask a much better question: "Has my original investment thesis actually changed?" If the underlying business remains strong, if economic fundamentals remain intact, and if the reasons you originally invested haven't materially changed, then temporary price declines may simply represent normal market behavior rather than a reason to panic. This mindset encourages rational thinking instead of emotional reactions. One of the most valuable things any investor can do is build a risk management plan before markets become volatile. Trying to create an investment strategy during a market crash is like trying to buy insurance after your house catches fire. Preparation always comes first. Every investor should establish clear guidelines covering areas such as maximum acceptable portfolio drawdown, position sizing, target asset allocation, diversification rules, stop loss policies where appropriate, portfolio review schedules, and regular rebalancing procedures. When you've already made these decisions during calm market conditions, you remove much of the emotional pressure that comes with falling markets. Rather than reacting impulsively, you're simply following a plan you've already developed. Now, let's talk about diversification because it's one of the most powerful long-term survival strategies available. Some investors criticize diversification because it may reduce spectacular gains during very strong bull markets. That's true. Diversification isn't designed to maximize short-term returns. It's designed to reduce unnecessary risk. A diversified portfolio spreads investments across multiple sectors, industries, countries, and asset classes. That could include domestic shares, international equities, government bonds, corporate bonds, precious metals, commodities, real estate investment trusts, and maintaining an appropriate cash allocation. Different assets often respond differently to changing economic conditions. While diversification cannot completely eliminate losses during broad market sell-offs, it frequently reduces overall portfolio volatility. More importantly, it makes it easier for investors to remain committed to their long-term investment strategy. Another area that deserves much more attention is position sizing. Many investors spend hundreds of hours researching companies, studying charts, and analyzing financial statements. Yet they spend very little time deciding exactly how much of their portfolio should be allocated to any single investment. Position sizing often determines whether a loss becomes a minor inconvenience or a major financial setback. Even exceptional investments become risky if they represent an excessively large portion of your overall portfolio. Professional portfolio managers understand this very well. They don't simply invest based on confidence. They invest according to predetermined risk limits. This disciplined approach helps ensure that no single investment can significantly damage long-term financial objectives. Let's also discuss cash because cash often gets unfair criticism during strong bull markets. People sometimes say cash is doing nothing, but cash serves an extremely valuable strategic purpose. Having available liquidity allows investors to purchase quality assets when markets decline. It helps avoid selling good investments simply to meet unexpected financial needs. It reduces emotional pressure during periods of heightened volatility. And perhaps most importantly, it provides flexibility. When others are forced to sell, investors with cash reserves are often in a position to buy excellent assets at attractive valuations. Another common mistake investors make is stopping their regular investments during market downturns. Ironically, falling markets often present some of the best long-term buying opportunities. Strategies such as dollar cost averaging allow investors to continue investing consistently regardless of short-term market conditions. When prices fall, regular contributions purchase more units. When prices rise, they purchase fewer. Over many years, this approach can smooth investment costs while reducing the pressure of trying to perfectly time market bottoms. Speaking of timing the market, let's address one of investing's biggest myths. Many people believe successful investing requires accurately predicting every major market movement. The evidence simply doesn't support that belief. Research has repeatedly shown that missing only a small number of the market's strongest recovery days can dramatically reduce long-term investment performance. That's why many experienced investors focus instead on maintaining diversified exposure. contributing regularly, rebalancing periodically, and remaining invested through multiple market cycles. It's a far less stressful and often more effective approach. Another habit that separates successful investors is maintaining the right time horizon. Financial media naturally focuses on daily market movements because daily news attracts attention. Long term wealth, however, is rarely built by reacting to daily headlines. Instead, experienced investors ask themselves whether company fundamentals have genuinely deteriorated, whether their investment thesis still makes sense, and whether temporary volatility actually creates opportunity rather than danger. Keeping your attention focused on years instead of days helps build emotional resilience. Every drawdown also creates an opportunity to learn. Once markets stabilize, it's worth reviewing your decisions honestly. Did you follow your investment plan? Was your diversification sufficient? Did you become too concentrated in one investment? Did emotions influence your decisions? What could you improve before the next market correction inevitably arrives? These reflections transform difficult experiences into valuable lessons that strengthen future decision making. Technology also plays an increasingly important role in helping investors remain disciplined. Modern trading platforms provide sophisticated charting, market research, technical analysis, portfolio monitoring, and integrated risk management tools that simply weren't available to previous generations of investors. If you're looking for a world class, cutting edge, user friendly trading platform app, I highly recommend exploring Crystal Ball Markets trading platform. You can learn more by visiting crystalballmarkets.com/platform. Whether you're a newer investor or an experienced trader, having access to professional grade tools within an intuitive platform can make a meaningful difference to how confidently you manage your investments and your risk. Education is equally important. Markets constantly evolve. Economic conditions change. Interest rates move. Entire industries emerge while others decline. Successful investors never stop learning. Whether you're studying trading psychology, portfolio construction, macroeconomics, risk management, financial planning, or market cycles, every new piece of knowledge improves your ability to make informed decisions. If you're looking for beginner friendly trading, investing, macro, and financial markets podcasts, I'd also encourage you to explore the Crystal Ball Markets podcast at rss.com/podcast/Crystal Ball Markets. It's a fantastic resource designed to make complex financial topics easier to understand while helping both new and experienced investors continue developing their market knowledge. Finally, I'd like to leave you with one thought. Patience may be the greatest investment advantage of all. Many people believe successful investors constantly buy and sell. The reality is often quite different. History has shown us that markets recover from recessions, financial crises, inflation, geopolitical uncertainty, pandemics, and many other unexpected events. Although past performance never guarantees future results, disciplined investors who remain committed to sensible long-term survival strategies consistently place themselves in a stronger position than those who repeatedly react to fear. So remember this: drawdowns are not signs of failure. They're part of investing. Successful drawdown management investing isn't about avoiding every loss. It's about preparing in advance, managing risk intelligently, controlling emotions, maintaining diversification, continuing to learn, and staying invested long enough to allow compounding to work its magic. Markets will always fluctuate. Headlines will always create uncertainty. Volatility will always test investor confidence. But if you remain disciplined, patient, and committed to your long-term plan, you'll give yourself the best possible chance of navigating every market cycle with confidence. Thank you so much for listening to another episode of Financial Market Insights for Traders. I'm Sophia, and I truly appreciate you spending part of your day with me. If you enjoyed today's episode, be sure to subscribe, share it with someone who could benefit, and join me again next time as we continue exploring the ideas, strategies, and insights that help you become a more informed and confident investor. Until next time, take care, invest wisely, and I'll see you in the next episode.